we understood EBITDA as a KPI, then OFCF, that is operating free cash flow as KPI, then earning per share, then return on capital employed. And in case of return on capital employed, we understood very clearly that in the numerator, we will not only take earning after tax, but we will also take the figure of interest, because return on capital employed tells us as to what is the return we are giving as a business to the people who have given us capital. Now, the fifth KPI that is used world over for the purpose of measuring performance, or for the purpose of business performance evaluation of businesses all across, is known as EVA. EVA stands for economic value added. Economic value added. EVA is considered to be the most comprehensive KPI for the purpose of business performance evaluation world over. And why is that so? And remember again, as we discussed in the beginning, all these KPIs that we are discussing in this session are universally applicable to all the industries, to all the economies, to all the companies, irrespective of nature of the business. Why EBI is considered as most comprehensive KPI for business performance evaluation, and that is because it takes care of both sides of a business, both sides of business. And how it is calculated? So EVA, economic value added, how do we calculate this? We will calculate it taking first the figure of ROCE, return on capital employed, right? ROCE, return on capital employed. That means any business, and remember this can also be calculated for the entities on whose boards you are sitting as nominee director. Now friends, before I discuss EVA further, let me tell you at this point in time, how do you make use of these KPIs? It's not that all of us need to sit and calculate these KPIs for the companies on whose boards we are sitting as independent director or nominee director. No, we do not have to do that. But what we certainly need to do that is to share all these KPIs with the CFO of the company, or the MD of the company, or CEO of the company, and advise them that every time when we have a board meeting, we would like all these KPIs to be presented in the board meeting every time. I will go one step further. Since our responsibility is to ensure the KPIs on the entities on whose boards we are sitting, they perform well. Since we have that responsibility, you can even advise the board of directors, or the MD or CEO or CFO, saying that not only present the actual KPIs, not only present what is actual EBITDA for the quarter, what is actual OFCF for the quarter, what is actual EPS for the quarter, what is actual return on capital of the quarter, what is EVA of the quarter, but also advise them that they must also have the practice of putting budgets also in the organization if they are not doing it actually. If they are not doing it, they must start presenting budget every year for the forthcoming year, and they should also present the budgeted EBITDA, budgeted OFCF, budgeted earning per share, budgeted return on capital employed, budgeted EVA, and also against them the actual of these numbers. And not only they need to present it for the quarter, but they also need to present for past years as well, so that it will give you an idea as to in which direction the company is moving. And I'm sure friends, by looking at these KPIs, you will be very easily be able to figure out कि ये कंपनी का में सब कुछ ठीक चल रहा है कि कंपनी में कुछ कुछ गड़बड़ है. तो जहाँ भी आपको लगेगा कि ये these KPIs are fluctuating, that means it's a signal that somebody needs to be given responsibility to find out as to something is going wrong, to find out as to what is going wrong, and then to fix it up. So this is what immediately you can, all of us can start in all the entities where we are there as a nominee director. And I can tell you, this will, friends, will increase respect for all of us on the boards of the companies where we are occupying the nominee director's position or independent director's position. Because all said and done, all the progressive managements, progressive companies, all the companies with progressive and forward looking outlook will always like that their nominee directors, their independent directors must get involved in the deliberations and the discussions which are taking place in the board. They would be happy not when the nominee directors or the independent directors are not raising questions, not asking questions. They would be happy when the nominee directors and the independent directors are asking questions, because it will give them a different perspective that would help them in improving the performance of the organization. So immediately after this session gets over, please shoot out a mail to all the entities listing all these KPIs and also telling them, as we have discussed, to do from the next meeting onwards. So how do we calculate the EVA, economic value added, is equal to return on capital employed minus SOCE. What is SOCE? SOCE is cost of capital employed. Cost of capital employed. So fortunately, all of us are bankers in one way or the other, and therefore who will understand it better than all of us? So obviously जिस बिजनेस में हम कैपिटल लगाते हैं उस कैपिटल की कुछ कॉस्ट होती है और उस कैपिटल पे हम कुछ रिटर्न कमाते हैं. तो वो जो हम कैपिटल बिजनेस में लगाते हैं, द कैपिटल दैट वी पुट इनटू द बिजनेस, दैट कैपिटल हैज अ कॉस्ट. It is known as cost of capital employed. And on this capital, we are earning return that we have discussed and understood. It is known as return on capital employed. So what is EVA? EVA is nothing but a return on capital employed minus cost of capital employed. Return on capital employed minus cost of capital employed. So let's say, for example, the return on capital employed for a company is 15%, and the cost of this capital, the cost of the capital which is employed in the business, let's say is 17%. Now please tell me, is this company creating value or this company is destroying value? So the number comes is 2% minus. So the EVA, economic value added of this company is minus 2%. That means this company is not adding value. This company is destroying value at the rate of 2% every year. And you can imagine, if a company continues to destroy value at the rate of 2% every year, how long will this company survive? Not very long. Not very long. And plus, since the company is destroying value, no investor, whether lender or shareholder, will be interested to put money into this business, and therefore this business will start running short of capital. And when the business start running short of capital, that means cash. That means it would be difficult for this business to survive, and this business in all likelihood will close down unless something is done to improve the EVA of this company. If the EVA of this company, if this return on capital of this company, let's say, is 17%, and the cost of capital of this company is 12%, now the EVA of this company is 5% positive. That means this company is not destroying value. This company is adding value. This company is adding value. This company is creating value. And that is what, friends, is EVA, economic value added. So this is all about this is how you will figure out or use the economic value added for judging the performance of the business on whose board you are sitting as a nominee director or as an independent director.